Welcome back. This is our third session for the night, trying to complete this question 45 of the kit here, Vog Q45. And we were just looking at note 6 when our session 2 dropped out. All right, so everybody seems to be back in the room. So, note 6, we were discussing why we would now choose the PBDIT. And let's see the guidance given to us by note 6 as Stacey mentioned. So it's estimated that that NEDGE can claim 10% tax allowable depreciation on its non-current assets. So this depreciation that we're looking at is for NEDGE only. So we shouldn't therefore be dealing with the depreciation of the whole company. And again, can we assume that the amount of tax allowable depreciation is the same as investment needed for NEDGE and not for the whole of TCO? All right, so we want to deal with the value before depreciation and only put in the depreciation that is related to NEDGE. Right, so is that the item that you were indicating first, Stacey? Okay, sorry about that. Yeah, so thanks for that credit there. Yes, Anita, that's what we need to be aware of. Good. So the one person who voted for that profit before depreciation, this is what we need to be aware of. And further, therefore, since we are going to be starting with profit before depreciation, we must now subtract the depreciation because we are told the tax allowable depreciation is the same as, right? The tax allowable depreciation is the same as what? Some level of investment. So is this normally, is depreciation a cash flow? No. And therefore, if we're looking for free cash flow, we will omit it. Or if we had started with profit after depreciation, we would add it back. Further, as I was discussing with Anita previously, if we had started with profits after depreciation, and we are told the same note here that the depreciation is the same as the investment, is the investment a cash flow? Yes, good. So therefore, while you would want to add back to your profits after depreciation, let me sort of write that here. So we will take profits after depreciation. We would want to add back the depreciation, and we would want to minus the investment level, because that one is a non-cash flow depreciation and a cash flow of the investment. But those two will net you off to the same place. However, that is when you are starting with profit after depreciation. If we are now starting, however, with profit before depreciation, should we now subtract this depreciation value? Or should we make an adjustment for it? So the idea is no adjustment down here, right? When you start with profit after depreciation, but if we are starting with profit before depreciation, we must now less one of the adjustments. Is everybody okay? And while the value is equal to the tax allowable depreciation, that's how we're going to calculate the value. It is really representative of the investment value, right? So to make that long story short, we have to calculate the value of the depreciation, which is equivalent to the cash flow of the investment, and we must subtract that from the profit before depreciation. Is everybody clear at this stage? So we will start off with this, or profit before depreciation. We'll calculate the value of depreciation, which is equivalent to the cash flow of the investment. We'll subtract that. and then we will continue working to see what else we can throw in. So let's go to our workings and start. I think I should write that down in the narration. What do you all say? Yeah? Nobody's saying anything, unless people type in yes, and I only have a bunch of yes on the screen. Not following which yeses for what. All right, so current levels. So I've already started the narration here. Current levels of FCF. So we are guided by note 6 that the depreciation allowable for NEDG, for ENCO only, is equivalent to its cash flow investments required to operate. Hence, to get to the FCF of NEDG or ENCO, we'll start by finding the proportion of B, which was 20% of the profit before depreciation, P, B, D, I, P, B, D, I, T. Then we will compute the value of the cash flow or cash outflow, I could now say, for investments needed for an edge, for ENCO, as the equivalent value of 10% depreciation right? And the only other thing else we will need to account for is the cash flow to department C, right? Final adjustment to ENCO's cash flows before accounting for tax will be the reduction in its income stroke profits from the discontinuation of segment C. And how much are we losing from there? That is 10%, right? So let's begin. So after that, I think that's all the adjustments. We'll deal with tax. And that's it. So let's begin. 40% of TCO's PBDIT is equal to 40% times, can somebody throw that value of me? 40% of what? Line it up here. Did 7.4. Right, what do we got? $1.96, very good. Next. So after we have that, we're going to say our depreciation. Less. So really I would want to say less investments. So less investments now would be the value of 10% of depreciation. And the depreciation, what did they give us for the depreciation? Value of its non-current assets. So you have non-current assets, 40% again. 40% of non-current assets, 98.2. Yes, no? Where is Anita getting 72 from now? Is that the final value? Yeah, 72. 40% of 98 is 70. That seems kind of high. Let me just double check that. 0.4 times 98.2. No, where did Anita get 72.4 from? All right, so she changed it up. So that's 98 here, right? So down here, depreciation equals 40% times 98.2. And of course, that's in non-current assets. And this is going to give me 39.28. And of course, I must now find that times the 10% would now be equal to how much I will subtract? 3.93. Right, so that's the investment value. Cash flows, that's going to be used up before we could find our free cash flow. So we have the profits, we have the free cash flow, and let's go back to that bit, which I know I wrote the note without really explaining it to you guys. Let me come here and explain it now. That note bit, which I just mentioned, was this note 5 that I kept passing by. And this note 5 is now saying to us that, oh, sorry, not 5, note 4. It's saying to us that at present 10% of B's profits come from sales made to C. So what are we doing with C? Aren't we selling C, disbanding it and selling it off for cash? All right, if we come back up here, the assets attached to C will be sold out. So therefore, do we have a department to keep selling to? This 10% of their PB, and look again, PBDIT. Good. So we no longer have this income. This PBDIT is going to disappear. And that's the adjustment note that I wrote in here also. Right? So that's at note 4. And where did it go? Here. Final adjustment here would be this. Right? From note 4. All right, so everybody okay with that? Was it 4 or 5? 4. All right, good. So let's go. Punch that in. Less lost PBIT. P B D P B DIT. So the PPBDIT was the 14.96. And we are losing how much of it again? 10? Good. What do we got? 1.4, 1.50. Minus 1.5. So I'm sticking to the 2 decimals. If you want to write the 3, that's up to you. But again, as I tell you, less numbers you write, the more time you save. So stick to your guns. Right. 1, 2, 3. And that's it. That's all the adjustments for n. So while the notes were all over the place, the actual computation is not so bad. So 1, 2, 3, and we now have profits before tax, if you want to call it that. So I would add this now up. Now again, another issue here is that we could have called this the depreciation as well, but understand that we wouldn't have to add back the depreciation because it was also a cash flow. So depreciation and cash flow coming into play with our minds here, right? So we can now apply tax to that at 20% equal 0.2 times that minus. Right, and now this will give you your FCF. FCF current. How much? $7.62. Good. So now we get on to what my opening paragraph for this area was talking about, our discounting concept. So we have current year, where we told the names of these years. Current year for the end of April 2014. So again, so all questions were in 2014, but then down to this note 5, first year of NEDG, and then annually thereafter. So we could say T0, which is 2014. So 2014, call that T0, T1, T2, onwards. Right. Now again, we'll have to use multiple lines here, unless we do what we discussed in the study school and put 2 years for T1. So it's up to you how we do that. I'll illustrate here using, come on, what's up with this? Using, let me center it instead. FCF, CF. So the T0 FCF 7.62. Again, we're dealing with millions, dollars, millions. And year 1 is growing by 20%, we were told. So somebody do that for me. Equal 1.2 times that. What's T1? 9.14. Good. Dropping that to 2 decimals. And T2. I wrote out the growth rate up here somewhere. No, I didn't. 10%, so I should have wrote that in here. So it wouldn't be scrolling back to the question. That growth rate is 5.2. So that's our G that we can apply in our DVM that we'll do just now. 5.2. Write it up here first. I'm going to stick it back into the note section. Note section. Too much notes here. Right here. From here to onwards at 5.2. Oh, I should put it in this time. After year 1 at 5.2%. Right, so that's perpetuity rate. Good, thanks, Issy. Throwing that in here, so somebody get me that FCFE over there. Equals 1.052 times that. Good, 9.62, and I'm dropping it again to our 2 decimal places. Don't waste time with that. Now, again, the answer sheet went ahead and did the discounting without labeling out the FCF. It's up to you. However you want to do your discounting, that's fine. So my discounted cash flow is now, so perpetuity, discount. So if I now discount, let me use the pen now. If I now discount this, it will step back 1 year. So let me discount that using the perpetuity discounting using with growth. Using DVM or KE model, whichever one you want to call it, and it's the same thing. So the FCFE T1 would now be equal to 9.62, the cash flow, times 1 plus G. I could do without that times 9.62 times 1 plus G, which we know is the 5.2%. So multiply by 1.052 over R minus G. And we know R is 10%, or 0.10 minus 10 over 0.052. Somebody crunch those numbers for me. And that is our perpetuity discounting, of course, with growth. So this here equal to, open brackets, 9.62, 1.052, open brackets, 0.1 minus 0.052. Come on. Somebody tell me a value. 210. Why does that look kind of large? Oh, it's close. Yeah, oh, all right. It's correct. Thanks, Kanessa. So I don't have that number in my answer sheet. That's why I was a little lost, but don't worry. We'll now get the discounted values down to T0. So we now could multiply, we could probably add up those cash flows and discount it. Yeah, so all of these now would be discounted to T0. So I guess I could do that. Let's add that. All right, so that's 219 is what we'll be discounting down to T0. So present value of N. Of course, we'll take this and divide it, or we could say multiply it by 1 over 1 plus R, or 1.10. And what do we get? Right, of course, this T0 cash flow. It's not really going to come into our discounting element. So it's the future cash flows that we're discounting. Equal that divided by 1.199.8. Okay. Present value growing 82 plus that. Yeah, that should be looking like it. Let me just add that back. 8.31. The answer sheet separated that into 3 parts. So I just put it together and discounted. Plus 182.11. 199. We seem to have a little more than them. We have 9 million more. Free cash flow growing in the first year, discounted at 10%. We have that. 7.62. We grew it, we discount it. And this value here, 182. So I'm just checking back. They have slightly different number. The present value of that. But I don't see any issues with our value. We have the T1, which we added to the other T1, and we discounted both of them. 219, 914. They discounted 914. They grew the 914. Hold on. Present value of cash flows from year 4 onwards. I think I see my error there. So I did a growth twice. So I have a little issue here. So notice we grew from T1 to T2, right? And that's what this here is. This is value which has already grown. But it's occurring from T2 onwards, and that growth is occurring from T2 onwards. So T1 to T2, here was the 20%. And if we grew, if we remember the dividend valuation model, what value is supposed to be here? D1 or D0? Anybody? Anybody? Yes. So that's supposed to be D0 if I am multiplying it by a 1 plus G. In other words, I am supposed to have used the 1.94. So if I am using the D1, this D0 times the 1 plus G is equal to D1. So if I'm using the D1, which the 99.62 is, then I cannot use another value of growth. Is everybody following that? So I have a little typo in my computation here, and let's update here, and we will get the answer from the answer sheet. So we're updating the 210. You cannot have this additional growth. That will actually take you into a D2 value, right? So we don't want D2. We need to have D1 divided by 1 plus G, or D1 times 1 plus G over your 1 minus G as such, right? So let's just make sure everybody clear with this step, with this addition that we have to go back and do. So our perpetuity discounting, the error was made there, right? So, hello, where's my stuff here? Enter. So 190.51, that looks a lot better in terms of closer to what they have. So 8.31, they have 8.31, the year one discounted separately from the perpetuity, and 182.11. Right, so my formula updated everything, 90 point something. Good. One more time. Any queries at this stage? You want me to go over back that D0 computation, or are we good? Could I see a type of yes for everybody, or G that everybody is good? Somebody type yes already. Other people in the room. Stacy is okay. Anita. And Kenny says okay. Right, so good. So moving on. So now we have this 190.5, and what are we doing with that? So is that the value now to add on to this column? Oh, I did so much writing in this column. Yeah, so it's only this pen part, so hopefully that wouldn't affect my formula. Yeah, if we do add that in, we still have to adjust with something. So we could add it as it is, or make the adjustment and then throw it across in that column. So this present value of n that we're getting from n, we have to do something else with that. Anybody remembers it? Where did it go? Funds raised from C, the 7% unsecured bond would now be taken over. What do we think it means by this bond will be taken over? Yeah, we'll have to subtract it. In other words, we have to pay for it, right? So again, what is the value of this bond? 7% unsecured, well, the whole bond being taken over, not part of it, right? The 7% unsecured bond will be taken over by 1, and assuming that the current market value is equal to its book value. Good. So with that, having gotten money, or having had the present value of n, again, we are less than a present value payment, less bond. Right, so with that, minus 40, and this is a value that will be taken forward to add on to the final computation, right? So again, this doesn't work in here, messing up my column, but I think we could live with it. So equals to that plus negative 40. All right, 150.51. So now I could total up my column and say total values after acquisition, and get another yellow line going here. Total sign. All right, come on, add up, people. Don't wait for me. So I'm adding all the way up. 1, 2, don't cross that yellow. So the three things, the value of the VNA that combined, the value of the sale, and the value of this N. And we now get something like 1,634. They don't have a total for me. All they did was net off everything. And we now find the value total value gained, which is now the maximum premium payable. There's a difference between these two yellow values. So that would be equal to this minus the other value way up on top, 13. right? 287, right? 134. So our numbers are a little bit off because of the 1.26 we use in the growth. Our growth was a little more accurate than theirs. They stopped off and used 9 for the PE ratio as well. Right, so this again, hold on, this two needs to drop down to 2 decimals. 278.13. And that's where our computations would end. Of course, the assumptions will now need to go in right here. Right? Lots of the general normal stuff, calculations, values used, assuming all of our numbers are reasonable, the 10%, the future cash flows, the PE ratios, all of these things. So I would leave a little note here. I have 3 minutes remaining in this session. Assumptions, see, get answer. Right? So that's a bunch of textbook assumptions, which again, people, easy marks just for saying all of the items which are estimated in the question case given, right? So it's just listing those out, right? We're gonna get to 2 to 3 marks, right? So those are the marks you should have been rushing for up front, right at the top, just as we outlined the methodology that we were going to, right? And of course, don't forget little narrations here during the question. Very important. So that assumptions part is the only part I don't have on this document. I did, however, copy off part A and part B and stuck it right here for you. So do give those a read, and those will, if they show up again, will be very straightforward marks. All right, so once more, any queries at this stage where we're going to close off here? People okay? All right, everybody else? So now was Anita, Stacy, Amara's okay, and Kanisa. Right, folks, so for those who still have energy, you still have some hours you could put in tonight, let me go. And thank you all very much. Keep studying. The more work you do, remember again, work done equals pass. Get the work done, people, and you will have your passes on Friday. All right. So once more, good night, everyone. Thank you for tuning in, and keep at it and keep praying. Good night. You are welcome, everyone.